Good afternoon, everyone. I'm just checking the number of attendees we've got here. We had quite a number of sign-ups. So what have we got? Okay, right, we've got 170 so far. So that's a good audience. So I think that's more than enough audience to get going. But we'll start off with some intros to allow people come in. I'm just going to put a message in the chat here. In terms of questions, we very much welcome questions from participants in today's webinar. Feel free to put them in the questions section, please. Please bear in mind, though, that none of the people here on the call here are lawyers. We are going to be talking about closing around the commercial stuff and high level some of the legal things. But yeah, if it's particularly technical, my recommendation would be head over to SeedLegals, where effectively our customer support team can help with that, provided you're obviously a SeedLegals subscriber, of course. And if you're not, you can easily sign up for a free 30-day trial. But anyway, let's get started. So welcome everyone to today's event. This is a SeedLegals hosted webinar, co-hosted with Angel Investment Network and Fuel Ventures. The subject of this is all about closing round, and if you're a founder, effectively what you need to know about this process. Now, let me first address that the word closing can have quite a wide definition. Some people might think of it as very restrictive, just the cash going in, landing in the bank account for a funding round. Some might think about the legals. Some might think about kind of warming up investors to get them to sign some documents to demonstrate commitment. Here it's going to be, I suppose the widest definition for us. Closing here means that the starting point is you are past those initial discussions with investors and the interest is really ramping up. Maybe you have a verbal offer, maybe you have your term sheet, maybe you're sort of trying to corral investors to get to that stage where you can get them to sign a term sheet. Either way, you're close to getting an offer and getting this over the line. So what we're going to do is effectively walk through a lot of those steps, going from ramping up investor interest all the way up to signing the legal contracts. And in terms of the panelists here, we've got I suppose some different people, different people in terms of the spectrums and the parties. So just to give to start off with the intros, my name is Nick and I'm the head of investor partnerships here at SeedLegals. For anyone who is new to SeedLegals or isn't aware of what we are effectively a law tech platform that has completely automated the process for doing the legals for your funding round. So using our technology, we can share with you data that effectively informs you on what is market standard or not for angel rounds or fund-led rounds. And then I suppose the real sort of selling point I would say is that we've digitized this whole process, making it a lot more efficient from a time and cost perspective, allowing you to minimize that time spent on legals and spend it on growing your business. In terms of my background, I used to work in VC before I came here, and now, yes, I'm on effectively the operating side. And I'm delighted today to be joined by effectively what I would say are sort of two partners with us who sort of share the SeedLegals vision, which is Angel Investment Network and Fuel Ventures. So why don't we kick off with some intros. Xavier, how about you introduce yourself, just a bit about what you do and what Angel Investment Network does.
Hi, so I'm a director at Angel Investment Network. We've been going for 16 years now. We've now got 40 networks around the world, platforms for connecting entrepreneurs and investors. We've got over 250,000 angel investors registered on there. I head up the broking team, which works on just 2 companies a week to help them raise early stage rounds and effectively get them to this stage that we're talking about right here. So I guess I'm here to talk a bit more on the dark arts, which are the kind of valuation and negotiation, and those bits about what investors expect from you in order for them to finally pull the trigger. And yeah, we've raised about 100 million just in our team in the last 9 years for about 450 companies. And yeah, we're totally sector agnostic. So yeah, work with any kind of company as long as it's looking good.
Great, Xavier. Thanks for that intro. Brilliant intro. Ollie, please introduce yourself and a bit more about what Fuel Ventures does.
Yeah, absolutely. Hi, everyone. My name's Ollie. I'm an investment manager at Fuel Ventures. Fuel is, to an extent, a relatively traditional VC firm. We invest at seed stage, writing tickets of anywhere between $500,000 to $2.5 million as part of an initial seed investment. For that, we are a lead investor, so we like to negotiate, we like to price rounds, we like to do term sheets, we like to do legals and all the above. Fuel looks at marketplace, platform and SaaS model businesses, both B2B and B2C. so quite broad. I think you'd probably class this as a generalist fund, but there are a couple of sectors we won't touch, key ones being medtech, biotech, pharmaceutical, crypto and tokenization at the moment, and also hardware businesses with heavy IP. We have about 43 companies in the portfolio at the moment, soon to be 44. I sit on about 7 of those boards, so I get a good overview of the companies as well. And my role really is to do the deal sourcing, to do the due diligence, to do the negotiation, term sheets, legal documentation, and portfolio management. So very actively involved in that process for Fuel. We're quite a small team, so we get involved in a lot of different stuff.
Indeed. Great. Wonderful, Ollie. Thanks for the introduction. Much appreciated. So before we kick off, I say just in terms of housekeeping, in terms of this, I suppose, present webinar or presentation, whatever you want to call it, this is going to be a relatively open discussion between 3 of us. I'll be moderating. As I say, we've got a nice balance here. There's Xavier, who works a lot with founders on the angel-led rounds, Ollie on the investor side, working in the institutional space. So I think we're going to get some really nice sort of insight shared here on both sides of that. So as I say, it's a relatively open discussion. You're welcome to put questions anytime you want in the chat, and we've got a hard stop at 5, but we'll try to get through as many relevant questions as we can. Okay, brilliant. So look, why don't we get started now? For I suppose all the founders in the room, the background here, when Xavier and Ollie and I started talking about this webinar and sort of brainstorming about I suppose agenda items initially, I suppose from SeedLegals, we obviously think about the legals and helping get founders investment ready from that perspective. And obviously, Ollie, as he mentioned, he deals a lot with the deal execution. That's something he's involved too. So I suppose we were thinking a lot about the legals, but actually it is a bit more about that. And I suppose only later in our discussion did we think about actually it's more than just legals that you need to do to, I suppose, get this round over the line. There's a fair amount of prep that needs to be done. So this is, I suppose, what we call our getting prepared and getting the house in order stage, which Xavier mentioned. So Xavier, perhaps you would like to come in here and talk about, I suppose, that kind of bit that's either kind of pre-legals or sort of in tandem with legals, of things founders should really be thinking about in order to, I suppose, get investors to pull the trigger.
Well, we were discussing this with Ollie in the build-up, in that once you've got investors interested, it's good to have the due diligence documents in place and a data room in place, so that when they ask you these things, I mean, Ollie was saying that if he asks for something and then they say, oh yeah, let me start getting this together, and then it arrives a couple of weeks later because they've had to put together all this stuff, then he's already onto another deal. And that's the same with angel investors. So it's good to have these as many of these items in place as possible. It might not be, I say business plan in here if there is one. You might not need the full-on 80-90 page document, but there's a difference between a deck and a business plan, and it could be that something more text heavy, that once you've grabbed their attention with an investor deck, that you would like to back that up. So if you're going deeper into marketing and the teams and all these kind of things, that you don't want to go into too much depth with in the deck, because a deck is supposed to grab the attention and then lead to them delving into more. So hopefully the deck and an initial chat and maybe an initial offer or a hint at what they might be wanting to invest will lead them to say, can I get a link to your data room? And so it's generally keeping your house in order, right? You've got articles of incorporation. Who else is on the cap table other than yourself? Any of the materials that you've got in place. Financials are very important. Obviously, they want to see that, over the next 3 years, potentially 4 years, what are the cash flows going to be looking like? Obviously, the team is super important, so they'll want to see some CVs in there. As much documentation as you can show on SEIS or EIS, and then just put in as much information as you can, because they're going to want to. In initial chats, you're going to be able to persuade them. Okay, we have potential deals coming through this. Can you prove this? Because just in a chat, they're not going to take your word for it straight away. And then other bits and pieces that you've done to bring you to this stage. So if you've done marketing studies, I mean, as much of the bare bones of what you're willing to show, you should show it. You know, they're coming on board. They're going to be part of this business. There's nothing you should be hiding from them. And the more that you can put in there, the more comfort you're going to give them in the due diligence process. So, you know, it's a relatively long list, but you should have a decent amount of it if you're already at this stage.
Yeah, just to follow on from what Xavier's saying, I agree with this. He's right. When we had this conversation previously, the conversation went to, well, actually, you know, I can go and I can ask companies for things, but actually, by the time the company generally gets back to me, I'm on to another deal. I mean, unfortunately, I say unfortunately, very fortunately, I'm in a situation where I see in the regional fuel venture sees in the region of 200 to 300 applications every single month. We get a lot of inbound, we get a lot of introductions. It's the nature of what we do, and it's the nature of what we look for. Striking while the iron's hot cannot really be underestimated. And actually, at the point where I look at the company, I think, well, this is a super interesting space. Actually, generally, that's off the back of something. It's not cold. It's because maybe I've read a really interesting article. Maybe I've seen a similar company, but wasn't quite right fit. It fits into my raison d'etre for that moment and for that time. So actually, if you can capitalize on that by having all of that information prepared, that's super, super helpful for me. Likewise, a prepared founder also gives me a very, very good position in terms of, look, this is someone that we can trust. I can give a lot of money to them, and I can trust them to produce what I need to produce if they come to me with all of that stuff prepared. One of the things I will say, and what we do see a lot, all of this list is super relevant. Initially, what I'll generally ask for is the deck. The deck for me is one of the most important parts. We do have a lot of companies that will approach us and they'll say, here's my business plan. It will be sort of 65, 70 pages and of Word document A4. Very, very difficult to go through. That's the, you know, initially I want to see a deck that I can go through. I can scroll through in the case of 30 seconds to a minute and get a flavor of the business, a flavor of the people behind the business, and really understand if this is something that ticks a couple of my initial boxes, fits within our remit and such. So actually, I would say that make sure that from an initial point of view, from an initial conversation point of view, that's your starting point. That's your springboard. It's that maximum 20-page deck, relatively text light, where you're going into a little bit more about the business, a bit about the marketing, a little bit about the team, which is the key focus, and something that I can go through in a relatively short period of time. There's a question there: does this apply to scale-ups? Yes, it does. All businesses should be prepared. Very early stage businesses probably won't have all of this information. They probably won't have all of this stuff, and that's kind of fine. But actually, especially if you're a scale-up business, which I would class as slightly later, absolutely, you should have access to all this information, and it should be ready to go for when your round kicks off, so that when people ask for that information, you can give them access straight away.
Well, I can't underline enough what Ollie said about looking like a competent entrepreneur, that you come with a deck that's really tight, that you come with all these documents in place. And it's just for me, because I see a similar amount of decks to, well, we see a similar amount of decks to Fuel probably every month, with about 60 to 80 per week. And things that stand out are how effectively is this message being put towards me, because then I know that I'm happy to present them to investors, because they're going to have a good journey. And just everything in space, and especially with early stage deals, you're investing in the team more than anything else. And if the team just seems on point, then it's a real good start.
Brilliant. Okay, great. Thanks, gents. That's some really good insight there. So yes, absolutely. In terms of getting your house in order, making effectively the VC's job easy as possible in terms of the speed of making decisions, absolutely key. So look, let's move on effectively to, I suppose, the sort of the grand milestone we're looking for in terms of closing a round, and that's getting to a term sheet. Now, I'm sure a lot of founders in the room here know what a term sheet is, but I don't want to leave anyone behind. So let me just kind of give a quick 1 or 2 liner effectively what this is. So effectively what the term sheet is, it's a high level document which outlines the commercial terms on which the investor or investors are prepared to invest in your company. And likewise for you, the founder, you should be thinking about what terms are important for you when the investors are going to be investing into your company. It's a completely non-legally binding document. But it's very important to get to this stage because effectively, it's a real kind of, I suppose, solidification of interest between the investors and the founders to strike up a deal here. Now, in terms of how this is done, I mean, it can be, I suppose it can be done in two ways. I think in the old days, founders kind of had to wait for investors to send them a term sheet, and in some respects that still does apply in when you're approaching maybe institutional funds like Ollie's fund or a Series A. But now, with SeedLegals being around for 4 years, our platform has effectively democratized the access and that education in terms of building a term sheet. So you as a founder actually now can come on the platform and I suppose educate yourself on what terms it is you want for your funding round, understand what's market practice, say an angel round, or a fund-led round, and then effectively build something out to take to market. I remember actually when I used to work in VC myself, it was uncommon for founders to bring a term sheet, but I must admit I was kind of always impressed when founders brought me a term sheet, because it showed that they'd thought about their deal, what they wanted, and ultimately, again, going to that thing we were talking about earlier in bringing everything up front to the VCs, showing effectively to the VCs that, look, there's a deal on the table here, are you in or are you not? Now, the chances are the VC may send you back their own team sheet anyway, which isn't necessarily a big deal. But nonetheless, thinking about this is super important. And what we want to talk about here is, I mean, I'm not going to go into sort of a big lecture on this, but I'm going to sort of high level talk about clauses that are particularly important for you founders to be thinking about in your term sheets. And then I'm going to hand over to Ollie, who obviously writes a lot of these, sees a lot of these. So I'd be really interested to hear, the investor perspective here. So, as I say, I won't delve in, I won't do like, serious long paragraph focuses for each of these points. But the first thing is, it sounds very basic, but the share class you're giving out is, that's an important thing. Now, for an angel-led round, it's very common just to give out ordinary shares, so i.e. shares that you, the founder, have with voting rights, dividend rights, etc. It may be the case that when you are approaching institutions, or maybe kind of a weighty, sophisticated angel, that they're asking for some sort of liquidation preference. As I say, it's more common at the institutional stage, but just bear in mind that liquidation preferences mean that the investor gets paid back before you, and they're really designed to protect the investor in the event of, say, the company goes bust, there's sort of a fire sale, or the company perhaps sells not at the valuation that everyone hoped at, and thus it sort of protects the investor's return to some extent. Second one is round structure, which I don't think is something that's probably considered by founders, or wouldn't have been considered by founders maybe a couple of years ago, because the way founders were doing this was effectively raising, I suppose, what we call the traditional funding round, i.e. raising one big sum of cash all in one go. So you might get a founder who's raising 500k, a million, 2 million, all in one go. And although that's good and that gives you a big sum of cash to play with, and you maybe don't have to think about it for, say, the next 18, 24 months, the problem is that you are having to effectively herd a lot of people all onto one bus at the same time. And that can cause significant delay to actually getting your cash and getting on with what you want to do. So have a think about, can you legitimately structure your round like this? Which might be the case if you have a fund who's willing to write perhaps the only check or be the significant lead in your round. But if you've got angels, perhaps the problem with, I'll say, one of the challenges, particularly with angels, if you've got a lot of them in your round, is that with more parties in that round, there's more risk of potentially one dropping off. So maybe rather than thinking about, do I want to raise, say, 500k, what about if I did it such that I could raise a comfortable amount that I can get going with what I want to do, say like 200k, but then effectively enable what we call a rolling close. So, i.e. agree with your investors that you can effectively take on a sort of additional tickets post around up to a certain period of time. The benefit of that being you've got money to play with now, you can get building on what it is you want to build. And then as you do that, you ultimately become more attractive to investors such that you can attract these sort of tickets on a rolling basis. Sorry, that was quite a long one to talk about, but it's kind of a relatively new thing. Option pool, one thing to bear in mind, that is something that will affect ultimately the valuation. Typically all startups are going to produce some sort of option pool to incentivize talent to stay and to join, but that will effectively, that effectively does affect your valuation. If it's pre-money, it means effectively you, the founders, are diluted. If you include it after the funding round, it means that effectively even the new investors are diluted. The most common position is pre-money, particularly if you're getting something from investors. And ultimately, what you can negotiate, I think, will depend on your valuation. In effect, also your negotiating leverage in the round. I'll try and lump the next two together, which is corporate governance and board composition. All term sheets and all kind of legal documents, funding rounds, are all about economics and control. This is very much about control. So, you'll want to outline with your investors effectively how, as a board and as a company, you want to operate. So, i.e., what decisions lie purely within the power of the company and the board, and do any of those decisions rely on the consent of the investors, i.e., known as investor consent. This is more typical in institutional rounds, where naturally they're deploying larger tickets, there's larger sums of money at stake, they're managing other people. So naturally, investors will want to demonstrate some element of custodianship. As Ollie said, he sits on 7 boards, and I'm sure Ollie will say it's not for his fund to interfere in the business, but likewise they're there to obviously act as, I suppose, an advisor as and when needed, a sounding board, but also to make sure that nothing completely goes off the rails in terms of the company. Ollie, I don't know if you want to sort of jump in there on that point. Otherwise, I can keep going, and you can share with me your sort of thoughts to be aware about in the term sheet.
Yeah, absolutely. So one of the only things that I'll add here is, and SeedLegals does make this quite easy, so this is something that we say. SeedLegals will give you an option when producing a term sheet, which is, do you want a smaller set or a larger set of decisions to sit under the investor majority, to sit under the board majority, things like that. As an investor director, we probably take, if we're looking at the sorts of rounds that we do, we take a very active position within our companies, and in all cases we'll look at the larger set of decisions. Now, the key thing to remember here is that with most investors, and what most investors will surely push, is cash efficiency and equity efficiency, but not day-to-day management. My job is not to tell you day-to-day how to manage your business, how to run the company, who to sack, who to keep, whatever it might be. My job is to make sure that from an equity perspective that we're operating on an efficient basis. It's also to make sure that on a cash perspective we're operating on an efficient basis. So when it comes to those sorts of decisions, the general things that we'll have a level of control over as an investor majority, as an investor director, it comes under different clauses, will be things like the issuing of new shares. It will be things like large debt facilities. It would be hiring people with a salary of over £70,000 and over 3 months for whoever 3-month leaving clause for the business. It will be things like issuing options. It will be things like that. So it's the control of large expenditure or control of equity events. It's not control of the day-to-day business, and that's something that obviously we talk about a lot when we talk to our founders.
I see. Cool. So continuing on from that, aside from just sort of the investors' role in the board, think as well as a founder what your board composition should be. Our recommendation for founders is to keep it lean and to keep it founder driven. One thing I think that a lot of founders maybe don't appreciate when coming into a term sheet is thinking about the vesting of their shares and also levers. Now, for any of the founders who aren't aware of what vesting is, effectively what you often see in pre-seed and seed rounds is that post the signing of a funding round, the founder doesn't necessarily own all their shares. Effectively, they're going to earn them over time. And the reason for that is actually fairly obvious, is because obviously the earlier stage the business, the higher the risk it is. And if you say had a founder who had 40% of the shares, and then post the funding round, say 6 months later they decides to leave, that leaves the company in a terrible position, because there's 40% of the equity where effectively no one's got skin in the game. It's hard for the company to attract sort of senior management with enough equity to effectively incentivize them to join. So to have that vesting is really, really important. Tied to that as well is also lever provisions. So what this means is effectively having a set of rules in place and agreed up front as to what happens should, say, a founder or a sort of a key employee with equity or options leave the business. How they leave is ultimately going to affect how their equity is treated depending on the manner in which they leave the business. Another thing I think which is sort of underappreciated by founders when it comes to term sheet is actually talking about their compensation itself. So some founders might not consider founder salaries, maybe because they're in a position where they don't want to. Sorry, my internet had an internet connection problem there.
You're back, Nick. Oh, maybe he's not.
Maybe he's not.
There was a question about this, and so I'm more than happy to go into it. So, while Nick gets his connection back, so when we put together a term sheet, one of the things that we do consider as an investor is founder salaries, and it is founder compensation. Now, that's not just founder salary, but it is also founder equity and its vesting periods as well.
Mm-hmm.
There was a question earlier about founder salaries and what we expect a founder salary to be, and the reality is that actually it's very high. It's highly dependent on the individual situation of the founder. We generally set our base position or our general position at about 50,000 a year, which doesn't seem like a lot of money for someone who is based in London or for someone who is running their own business, and especially for a founder that may have raised somewhere in the region of £1 million to £2 million. But actually, our job at Seed is to be as capital efficient as we possibly can to make sure that we're getting to that Series A. Now, it doesn't mean that all of our founders have. It doesn't mean that all of our founders start on a £50,000 minimum, £50,000 a year salary. What it does mean is that those founders within our business that can cater for such a position and can cater for such a salary generally do. Those are generally younger founders who maybe don't have any dependents, maybe don't live on their own, and rent rooms with friends and things like that. We do have older founders within our portfolio as well who do have families, who do own property, who do have other expectations within lifestyle, who do start on slightly higher salaries. What I will say is that none of those salaries are excessive. None of those salaries at initial point of investment are over 100,000 a year. In fact, I don't think any of them are over 90,000 a year. I think our average as Fuel Ventures is about 60 to 65,000 a year.
That's what we expect as well when we see people coming to us. A range of, especially if they're younger with no dependents, probably 40 to 50,000, and then a bit more obviously if there are more responsibilities.
Absolutely. Lots of our founders as well have conversations about founder vesting, and again, I know there's lots of questions here about valuation. I know Nick has probably something to say on that, so I'll leave him to hopefully come back into the conversation to lead that. Founder vesting is a very important part of what we do. I think a lot of founders get a little bit shocked when they see a vesting clause. You're right, Nick.
Yeah, sorry, I actually have been watching the last couple of minutes. My internet went out and then I had to join back in, so apologies everyone there.
That's fine. I was literally just giving a summary on founder salary and founder vesting.
I heard. Yeah,
great.
Absolutely.
So just to summarize, guys, when it comes to founder vesting, from our point of view, we generally set a 4-year vesting with a 12-month cliff. We do have what's called a 100% founder vesting acceleration clause. Really, that whole position from our point of view is a balance, and it's a balance of we as the investor and the largest individual shareholder in the business, external to any of the founders or external to someone within the company, to an extent, we deserve the right to make sure that our position is protected, and it's protected for a significant period of time, because we are actually, in terms of cash, the largest investor into the business. The vesting clause for us is super important, because what it means is that if for whatever reason the founder decides to walk away from the business, it means that it gives us a period of time in which that if the business hasn't, if the business either hasn't grown or isn't the size that we need it to be in order to bring someone purely on a salary basis, we can release some of that equity to bring new people, to bring new CEOs, to bring new C-suite people into the business. So that's really, really important for us. Likewise, the founder vesting acceleration clause is important because it means that actually from your point of view, you're protected in regards to unvested shares if the business were to exit early. So it's really a bit of give and take in that regard, and that's really important to what we do, and it's something that we have for all of our founders.
Yeah, thanks for that, Ollie. And if and for founders out there, so if you're looking for further data on, let's say, what you see in terms of standard vesting arrangements or founder salaries, you can head on to SeedLegals deal data, and we basically kind of show you how those sort of arrangements flex with the size of the funding round, and also I suppose the valuation of the business. I think what Ollie said there in terms of for a 4-year vesting period with a 1-year cliff, that's fairly standard for a fund there in that respect, and that's all highlighted on SeedLegals. So look, just to kind of cover off the last things, warranties. I think another thing for founders: be aware that you are selling equity in your business, and thus you are making representations about your company. Now, obviously, you've said to the investor, "This is our mission. This is what we aim to do." But as a part of the legal documents, you will be there to effectively warrant that the company is what you say it is. That there are no sort of hidden nasties about it. There's no outstanding litigation. So you will to, to some extent be put on the hook. Now, generally for founders, particularly at the early stage, it's not going to be, we wouldn't recommend putting in an astronomical sum, but the typical thing you tend to see is maybe like a multiple of salary, maybe like 1 times annual salary. So i.e. an amount that sufficiently puts you on the hook and incentivizes you to disclose everything up front before you sign anything. Also, just be aware of just kind of what I call the extras that you might see from some investors. So particularly institutional investors, you will see fees. These are standard, particularly for SEIS and EIS funds, because unlike I suppose VC fund structures, they can't charge their investors. They effectively, the fees come out of the capital. And also bear in mind, particularly with a fund, it is likely, given the amount of work they have to do the due diligence, they want to, I suppose, protect their right to be in that investment by effectively granting themselves some exclusivity for, say, a 30 or a 60-day period. So those are some of the clauses to be aware of. I left valuation till last because I feel like that's one of the meatiest things. So let's now get on to valuation. So Sav, let's go back to you. You deal with a lot of founders and angel type rounds. Valuation is a question that's asked by so many people. You hear it's an art rather than a science. At SeedLegals, we get asked about it all the time. We don't perform official valuation services, but what we can do is provide data to say, look, this is the sort of standard amount of equity that's being given away and around, and this is the sort of the valuation. So how do to tell us about your experiences of dealing with founders and in angel-led rounds and valuation?
As you say, it's an art, not a science at this stage. And I think Ollie touched on this when we first met up to talk about this discussion, and it's about how much you're willing to give away, how much skin you've still got in the game. And I think that also reversing back to what we were mentioning before is rolling rounds. Do you need to necessarily raise that much? Because let's say you want to give away 25% of the business for this particular round. It's a rough figure, but there's actually a very good article on SeedLegals about how much you should be aiming to give away. But let's say between 15 to 25%, something like that. Now, if you think, okay, I need to raise all this money in one go. Let's say I'm raising 1 million now. If you're giving away, let's say 25% for the sake of maths, that means you're valuing your company at 3 million pre-money, but that might not be the story to investors who are looking at it. Could it be a question of raising a smaller amount before? We didn't really discuss this, Ollie, before, but I was thinking that, are there situations when you might want to get a certain amount in? We were talking about the rolling rounds before, then hit certain milestones and be able to then back a chunkier valuation at the next round once you've hit certain milestones. That's often something that I will suggest to people, because they'll get advice to raise a whole load in one go and tackle a market. Okay, you're an early mover, tackle this market, raise 2 million. But then if that has to then value a business very high, and then that's going to put off investors, especially if they see, okay, he's got to raise 2 million. Who's going to dip their toe first into this investment pool? So you've got to think about which stage you are in the business in order to attract different levels of money. So that's one thing that I tend to look at a lot.
Cool. And Ollie, share with us your thoughts on valuation here, because I think I think some founders I've seen in the past think VCs are all about there to make it as cheap as possible, but I don't think, at least with a good VC, that's the case. So tell us what you focus on when it comes to valuation.
Yeah, and I'm going to try and address some of the questions as well in this conversation, because I think it makes sense. I mean, I know Jerry, you asked about valuation and how much you're raising. 1 million for 10% equity, well, the 10 million seems a bit high and things like that, and you're right. So let me give you my overview on valuation at seed stage, and that's generally where I invest. It's companies that are making early revenues, but somewhere in the region of 10,000 to 100,000 pounds a month, which in the scheme of VC is obviously very low. It's very hard to value businesses based on revenue, based on those sorts of revenues that we're talking about there. We can use it to give indication, but it can't give us solid answers. And actually there's much more nuance, there's much more art as opposed to science behind those decisions than you'll find at Series A, Series B, Series C. Even Series A will have a decent level of nuance behind it. So when we're looking at valuations at seed, pre-seed, and probably Series A as well, in my experience, the biggest factors that go into those valuations is not to an extent actually progress. It's actually competition and it's dilution. Those are the two biggest factors that we have to consider as an investor. The reason being is that as an investor, we write relatively large tickets. I mean, £500,000 to £2.5 million. And there are businesses out there that are very interesting businesses in fantastic spaces that are growing their early revenue, but actually are looking to raise a substantial sum of money, which on paper, if you were to look at just the pure metrics of the business, you'd think there is absolutely no way that business is a £6 million business. The business is hardly making any revenue. It's doing, 20k a month. How can it be a £6 million business? The reality is that as a VC investor, if we want to write a £2 million ticket, then we have to value businesses like that. And the reason is because actually we can't take too much equity. As I've mentioned earlier, that generally in a seed round, we'd be looking to take anywhere between 15 and 25%. That sort of sits with what Zav mentioned. Now, if that's the case, I can't give you a £2 million ticket and value you to an extent as the market would value. You might be a business doing 20k a month in revenue. Okay, great. You're a SaaS business doing 20k a month revenue. You're doing 240k a year. Let's give you a generous 10x multiple on that 240k a year. Oh, great, you're a £2.4 million business. I can't give you £2 million if actually I'm going to value you at 2.4 million, because actually from a dilution perspective, I'm going to take too much equity within that business. And what I'm going to do is I'm going to scupper my chances for a proper Series A, a proper Series B, and a proper Series C. And that shoots me in the foot as well as shooting you in the foot, because actually the businesses that we invest in generally are going to go on to raise a Series A and a Series B and a Series C. So actually we need to look at the amount the company's looking to raise. Do we feel that that amount is suitable for the company at this point in time? Do we feel like they need to raise that? And if they do raise that, they can use it effectively. And then how does that affect valuation? So we have businesses within our portfolio that we think are actually, compared to a lot of the market, priced very, very reasonably. But if you were to look at them on paper and you were to look at them just on a pure statistical basis, you wouldn't think that they were valued at the level that we're valuing them at. And that's kind of just how it goes sometimes. So that on top of the competition element, which is another very important part. If you've got lots of people interested in you around, if you've got lots of people that want to lead, if you're a hot company in a hot sector, then generally that's going to drive the price up, because people are going to come in, oh, we'll give you a 4 million pre-money. We'll give you 4.5 million pre-money if we win the deal. Well, we'll come in and give you a 5. And that's, you start that slight bidding process, what we refer to as FOMO, fear of missing out, right? You're going to start that bidding process, and that's going to start increasing a little bit. The terms are going to start to get a little bit more generous. So to an extent, some of these comments are right. And Jerry, your question about, how much equity can you give away in exchange for a high valuation? If you're raising $1 million and you're looking to give away 10% equity, the 10 million seems astronomical. It would be a 9 million pre-money valuation. And, if you're a business that's doing 10k a month, let's say hypothetically, that seems astronomical, and it is astronomical. And you're right. Investors like me wouldn't get out of bed for 10%. If I'm totally honest, I wouldn't be interested in 10%. I would go higher. But that obviously relates to the pre-money valuation. And you may still look at the pre-money valuation and think, well, actually, on paper, this seems a little bit illogical. But actually look at the market around you. What are the companies, similar companies to you, doing? What are the sorts of valuations that we expect at certain raises? What kind of multiples are companies like you getting? When you get to your next round, what are you expecting to hit in terms of valuation? Are you showing a significant uplift? There was another question earlier about valuation uplift. And I can't stress enough that reasonable valuations are super important, because actually a big part of VC and a big part of a funding journey is the story. And actually people want to see consistent progress. They want to see consistent progress every single round to show, oh, we've gone from a 5 million to a 15 million to a 50 million to a 100 million pre-money valuation in subsequent rounds. If your round gets too hot and you start giving away equity at, a £15 million valuation right from the word go, then actually the problem that you're going to have is that if your round's not so hot 12 or 18 months down the line, then you're going to start looking at down rounds potentially. Yeah. And actually that becomes really toxic, because actually it's not great for the story. You want to show consistent growth. So that's something to keep in mind as well.
Yeah, that's one thing that I see quite a lot of are people coming with down rounds. There's obviously it's lovely to think that, okay, I can get this big valuation. My company is valued at X, but obviously, especially at seed stage, revenues and things, it's difficult to your numbers aren't saying much at the moment. You might be just earning 10k or whatever it is per month, But then once these seed rounds come in, this is when your numbers are going to start becoming more concrete. And then you're going to get to a stage where a bigger VC is going to look at those numbers. And if you haven't hit certain milestones to justify, you know, an £8 million valuation, then you're going to be in trouble, because you're going to have a down round. And, you know, as Ollie says, it becomes really toxic at that stage.
Brilliant. Thanks for the insight there, gents. Cool. So look, let's actually get on to sort of the last part of this, which I think is how to manage the negotiation.
Oh.
His internet's not being kind to him.
Yeah, absolutely.
I think, I mean, maybe while because we've got, and there's a few questions in the questions tab. So, oh, here he is. He's back.
Sorry, I'm so sorry. I don't know my internet. I don't know what's going on here today. So look, maybe before we go to questions, we can cover this quickly, because I think there are a fair few questions. Just want to talk about managing the negotiations, I suppose, what that means. And I think it's good that we have, I suppose, Zav from Angel Investment Network here and Ollie from sort of the fund led, because I think those kind of rounds have different sort of dynamics. I think maybe with angel rounds, it's more about logistics you need to worry about, and obviously terms to some extent. Maybe in seed rounds and institutional rounds, sorry, I should say, it's more about terms and things to be cognizant of. So Zav, can we go over to you to talk about, in terms of, you know, managing negotiations in an angel-led round? Because so the differences here is you could have multiple parties, not necessarily anyone taking the lead. So, you know, from your experience, what would you advise founders in those sort of scenarios?
I mean, it's a simpler beast the earlier you're raising. If it gets to institutional level, then you're being led usually by the institution. But if you're at angel level, you know, obviously as much information, SeedLegals are fantastic for that, and getting set up in that way. Now, if you've got your documents in place, a lot of companies that I deal with, they have an investor that starts to get interested in it, and then can start helping hold their hand through this initial process, and maybe put the initial tweaks to a term sheet that might be required. That tends to work quite well. Obviously, finding a lead angel, you need to have your ducks aligned, your ducks in a row, in order to get to that stage, and then have someone that will then step in and say, look, this is where this is where I'm comfortable. You're obviously going to be doing due diligence on them to see what kind of background they have, that they know what they're talking about, because then they will know the balance of how much skin in the game they want versus how much skin in the game that you should be having to keep you focused on it. So you know, it is a situation to be prepared, to not have something too big, not have something too small. Speak to as many other founders. Obviously, founders are a great source of information at this stage, because they've been through that, and they can, you know, give you honest feedback. This is a time to get as much information off as many people as possible.
Brilliant. Ollie, now over to you. Obviously, you know, in an institutional round, typically you guys are doing the leading. So I imagine more of the thing here is not worry about how do I coordinate all this, but more about concentrating on the terms. So I'm trying to think of the best question here in terms of, like, you know, maybe there are a few questions, like, what are deal breakers for you?
Okay. So I'll try and get us through this relatively quickly, guys, because I appreciate there's some questions that we want to answer. But when it comes to us and Fuel Ventures and other VCs, generally we lead the rounds. What that means is that we produce term sheets and we produce documentation, as opposed to with angels, where you're likely to have to produce that for them, and then they're likely to have to agree to it. Are there deal breakers? Absolutely, there are deal breakers, but from our point of view, we set the terms. So actually, when you go into that negotiation, you should be pretty clued up on what we expect. We as Fuel Ventures, I can't speak for other VCs, but we as Fuel Ventures are very clear that the terms that we put together are relatively market standard, that we don't really put anything together that's not, which means that when we go into the negotiation, we don't go in what you might call a hard position. It's not a case of, right, we're going to take what we can get and it's your job to negotiate your way out of it. It's sort of, look, here's sort of a relatively standard set of terms that we put for all. If you want to have a discussion on some points, then absolutely fine. Are there a couple of hard no's for us? Yes, I know. I think it was Miriam earlier said, I'm not sure the founder vesting clause is fair if someone's been working on a company for a year. I'm sorry to say, Mariam, I completely disagree with you, but that is kind of what it is. A year is nothing in the grand scheme of things. I don't want you to be here a year. I want you to be here for 5, 7, 8, 10 years. So actually that doesn't really tell me a lot. If a founder comes to me and expects to have no vesting period on their investment, or if they want 50% vested up front or whatever it might be, that's a big red flag for me. It concerns me that you need so much equity up front. If I'm giving you the leeway on the other side, which is that actually we fully accelerate unvested equity in a position of an exit event. So it really concerns me if you're demanding all that equity up front, considering the amount of money going into the business. The other things that are real killers for us are founders that demand too much in salary. We do have conversations with people where they expect to raise, a $1 million seed round and start on 150,000. Your lifestyle is your lifestyle. You're absolutely, free and able to do with it what you wish. What I don't like is when founders say, well, I could just go and get another job and I could get paid 200 grand a year. Well, do it then. Not my business. If that's what you want to go do, you go do it. If you want to build a startup company and you want to run a relatively lean business, then that's a decision you've got to make. It's not a decision for me to make. But what I know is that you're not getting paid 150 grand a year from the seed round. When we get Series A and Series B, there's absolutely conversations that we can have with any new lead investor that comes into it. Other things are more flexible. I think the reality is that as long as there's a level of, there's middle position on most things, but at the same time, I think what you'll find is, especially with term sheets that come from SeedLegals, there's not going to be anything on there that's particularly callous or particularly odd, or because it's a templated term sheet. So that would be my position, Nick. I hope that answers the question. Like I said, I don't want to spend too long on it if there's specific questions.
No, that was certainly very useful, Ollie. Actually, but I suppose one thing actually to talk about, Ollie, is in terms of the negotiation itself. In your experience on deals, where does the majority of the negotiation take place for you? Is it around the term sheet, or is it more in the legal docs, which in fairness are mostly a reflection of the term sheet plus some sort of nitty-gritty parts? Where does that kind of occur for you in the rounds you do?
Sorry, Nick, I lost you there for about 5 seconds. I think it was my internet that time. Can you just repeat that?
Okay, I was saying in terms of the negotiations for you in your rounds, where typically does that take place for you? Is it around the term sheet? Is it more around the legal documents, which are just basically a reflection of the term sheet plus some extra nitty-gritty? Tell us a little bit about it from your experience.
The majority of negotiation we do is around the term sheet itself.
Okay.
And the majority of those negotiations generally center around valuation, because valuation is the thing that founders tend to relate best to. Like I said, I don't find that overly concerning. The terms that we put together are market standard terms, so it's not like there's any terms in there that I think, oh God, that's going to bite us in the arse later. But the majority of those conversations go around, definitely around term sheets, because that's the point where you're signing a piece of paper. And you're right, it's not a legally binding document, and the reality is that you could walk away from that. The other reality is that I can't see your emails. I don't know what other conversations you're having, right? So who am I to start enforcing anything on that term sheet? But it's the point where you're signing a piece of paper. So understandably, it's the point where we tend to get the most negotiation. Once that is being ironed out, generally we don't get hardly any or not a lot of negotiation on the actual documents themselves, because they are a reflection of terms that we've already agreed to. So that's generally not particularly problematic.
Okay, cool, brilliant, thanks. All right then, well look, we've got 10 minutes to go. We've got a hard stop at 5, and we've got a decent number of questions, some of which we've already answered, so I'm glad we can get to them. But let's get to some unanswered ones. I've got a good one here actually. I think this could probably go to Zav first, because I think this is probably quite well to Angels. So Jack says, if your round is oversubscribed, does it look bad to increase the valuation of the business mid-round? Now, I only have limited experience in this, and I know one prolific London tech angel investor who says if anyone tries to increase the valuation during the round, he will never invest in that founder ever again, or try to invest in that founder ever again. But Zab, maybe on your thoughts there from seeing a lot of angel rounds.
Very, very rare indeed. They would have to have a very good deck of a hand of cards in their hand in order to pull something like that out. I would say go into it thinking, how much am I willing to oversubscribe by in this round? If you do have a large number of people queuing up, it's good. I've just had something like that just happened to me this morning. They were going to raise 750. They knew the hard cutoff on the oversubscribing would be 1 million, and they've had to turn some of that money down. But then you're in a good position to be talking to people already for your next round. As an entrepreneur, you're already thinking about the next round. Really, you're raising from the moment you start the company until you exit, more or less. So I would say stick to your guns.
Okay.
This fits well nicely into a question that Craig had as well. Craig, you had a question a while ago about early investors and signed onto your term sheet. How best to accommodate later investors that may want to tweak one or more of the terms, and this kind of fits into that a little bit. The reality is that a term sheet is a term sheet, right? That at the point that term sheet is signed, at the point that term sheet is agreed to, effectively you've put a lead investor in place. It's the person that signed that term sheet first, that has negotiated the terms and that has agreed to the terms. I would be in line with the tech investor that Nick mentioned. If halfway through that round, if I'd signed onto a term sheet, I'd looked at the terms, I'd said, yeah, I'm happy with these, I agree with them. If I'd signed onto that and then halfway through the round, I got told that they're going to increase the price, I would be pretty miffed and I probably wouldn't invest either. The reality is that, the term sheet at the point where you sign it is the point that you think is fair. Whether the round is oversubscribed or not, I don't want to be involved in a company where it's pay to play. I want to be involved in a company where we're bringing on the best investors who can give you the best advice, who can open the most doors. Pay to play is weak, because actually, from my point of view, it means that the people that I'm sharing the board with, or the people that I'm sitting next to at the round table, aren't bringing as much as I am. And that for me means that I'm feeding people off of my equity and my work that shouldn't be fed. That's my general position.
Yeah, I mean, I would assume basically, like in a fund-led round, it's generally going to be harder to accommodate tweaks unless they are kind of really innocuous to you as a fund.
Absolutely.
If it's an angel-led round, I presume again it's all to do with, I suppose, the number of angels you have in the round, who's providing what cash, and effectively the balance of power, and also the nature of the tweaks. So it's a multifaceted question, I'm afraid, that probably needs to be visited on a case-by-case basis.
Yeah, absolutely.
Cool. Okay, so look, let's there's some other good questions here. So look, we talked about the roll and close model here earlier. So people raising less than a round and then sort of giving themselves a time window to effectively go out and raise an extra sum of cash. I have seen this myself personally in a Series A, not necessarily raising I would say probably 80% or 90% of the cash, then allowing themselves a little bit of headway to raise further cash. In angel rounds, we see it quite a lot. Ollie, from your perspective as a fund, how do you feel about this model?
It's usually not something that's overly applicable, and again, kind of goes into a few questions. There's been a few questions about things like safe notes. In the UK, I never refer to them as safe notes. I generally refer to them as ASAs. We're an EIS fund, so ASAs are generally the route that we go down, or convertible loan notes. Very similar instruments, all have the same intention. We as a fund don't sign up to safe notes, convertible loan notes, things like that, which means that the idea of a rolling close is sometimes a little bit difficult. We do have, for instance, things that say, okay, you're raising a 2.5 million round, we're going to give you 2 million. Hypothetically, and there's room for other investors who could then come in after that. That is super rare for us, because actually the reality is that if we like a company enough, we want to take the round. We don't want to. In an ideal world, unless there's some real big value add investors who are coming on board, we don't want to share equity, because why would we, to a certain extent? So in a lot of cases, when we invest alongside mainly when we co-invest. By co-invest, we lead the round, but when we do have co-investors in the round, generally they're angel investors, because angels, from our experience, tend to bring more bang than buck, which means that they get a position at the table, they can help us, they've got good experience, whatever it might be. But it's not sort of a passive fund who's going to put in a couple of 100,000 and not really bring much for that. So a rolling close is not something that we will generally do. Generally, because we'll say, let's close the round, let's get the money in bank, we'll take the vast majority. If there's a couple of others that want to come in, great. Otherwise, we're going to take the rest of it. Let's get back to business. Let's get you spending the money and doing what you do best, which is building. So yeah, not very common from our point.
Just going back to, Ollie, just going back to your point on loan notes and ASAs, they just from my experience, our investor database aren't the biggest fans of them. A lot of them can't really see the benefit for them of investing like that, and will want to go for straight equity most of the time.
There is a definite place for them, and we have seen some of our companies subsequently go out and raise under mainly convertible loan notes or ASAs. There is definitely a place for them. We do see them from like Series A funds. Series A funds, if they particularly like a sector or particularly like a company, sometimes drop in with a smaller ticket under an ASA earlier on, and then that will convert at a round that they then end up leading at Series A, and that's okay. That's not a problem. We don't get involved with them mainly because our investors are majority EIS investors, and under an ASA is EIS qualifying, but it just causes a lot of faff. It's just another thing to deal with, which is the conversion point, and then the shares issued point post the conversion point. What tax year am I in? You know, is it this day tax year or this tax year? I invested because I wanted this tax year, and things like that. So we don't get involved in that. At least
from the experience we see on SeedLegals, a lot of people who raise saves. We have seen ones that have been done by funds, some rather large checks, but typically, yeah, it's done by, I suppose, angels who are committing relatively small tickets but high volume in the anticipation of then, like, say, kind of an institutional round coming up in, say, 6 or 12 months time or something like that, where someone prices the round. Okay, look, we've got 3 minutes to go, and I appreciate we've got a hard stop at 5. Saw a good question here. I don't know if it's from the same Craig. Going back to this thing about exclusivity periods, what's your view on investors wanting exclusivity in negotiations? Is one ever appropriate? Now, I suppose, speaking as an ex-fund investor, I would argue there is validity to having exclusivity, given the time and resource that goes into vetting that deal. But Ollie, you could talk about it. But Zab, also, you know,
I think earlier stage probably not so much. I think once you get to an institution and the amount of work that needs to go in, then as a founder, you would expect for there to be an exclusivity period. In terms of angels, it's more of a free for all, and you're going to be looking at so many different angles at that stage that I don't think it would be so applicable.
Yeah. A quick one from me. Yes, we always do have an exclusivity period. The exclusivity period is not for us it's post-term sheet. It's not for us basically saying you can't speak to any other investors. We do have companies that say, oh, we're having conversations with angels. The exclusivity period is not for us to say you cannot have any conversations with angel investors, or if you've told us the round is slightly bigger and you want to accommodate angels, you can absolutely have those conversations. You can show them the term sheet. You can say, these are the terms that you'll be investing under. That's fine. What the exclusivity period is designed to do is it's to stop you from basically signing for 3 or 4 term sheets, and it's to make sure that we've got enough opportunity, we've got enough time post the term sheet closing, post the term sheet signing to close the round. Make sure that we've got all the documentation we need and to do that, and to do it on the terms that we've agreed in that term sheet. That's what it's designed to do. It's not designed to constrict you from raising if you're going to raise from other investors.
Brilliant. Okay, well, look, we sadly only have 1 minute left, so I think we have to wrap it up there. We should have probably had a bit more time to get more questions. But look, if there's anything regarding commercials, legals for raise, guys, please feel free to head over to SeedLegals, where we'll try to help you the best we can. But allow me to extend my thanks to Zab and Ollie today. I think it's been a really good discussion. Some great questions from the audience. So please let me extend my thanks, guys. And I'm sure we'll probably be having some future webinars together again.
Thanks for having us.
Cheers,
guys. Thanks very much. Bye-bye. Appreciate it. Bye.